Hello traders, Mark here with Flipside Trading. Good evening. It's April 19th and we're taking a look at another version of On the Brink. Our core focus here is, okay, we have a new economy out based upon COVID-19. New ways of interacting, new ways of making money. What does that look like? How can we as a retail investor, potentially take advantage of that? Remember, this is not investment advice, right? This is education only, okay? At the same time, let's also take a brief look of where we're at the SPX and how that may affect some of these opportunities going forward. So let's dive right in. Okay, so the first thing we can see is SPX is still moving higher, right? It did what we talked about, kind of bounced around here for a couple days, and then all of a sudden we got a big push here on the last day. And that big push was basically predicated upon kind of two things. One, Gilead came out and said that they had a potential treatment that looked good based on the initial cases and studies that they were doing, which then attenuate the overall effect of the virus and allow people to get back to work sooner if they are infected. Number two, we're starting to see, at least in the initially hard-hit areas, New York and California, kind of the epicenters of the virus, we're starting to see those not the yield curves, but the curves as far as people diagnosed and deaths, we're starting to see those flatten. Unfortunately, where other parts of the country are going to, see increases and those numbers are going to go up, but it's really serving as a proof that these social distancing measures do work. And it's allowing talk for a partial reopening of the economy. And so that's burgeoning good news. And you can see that we'll probably, I think that'll continue to push us up a little bit, this week, up to this confluence of the 50% and the 618 Fib levels to the 2930, which kind of also corresponds to the initial top range of this of this wedge. Obviously by the look of this potentially overall is a bearish wedge. It doesn't become bearish until we break it. That could happen. We could see a pullback at some point in time, but right now I think we're moving up, and one of those reasons why I think we are, at least incrementally, right, not a total V bottom, is the banks came out and they went down, even though all the big banks, Goldman, Citi, Bank of America, had their average revenue decreased by 45%. They basically held the channel, and they're starting to move up. And if they actually move up to this level here, which is the top of value, or get to the top of channel, that'll probably correspond to that incremental growth and kind of serve as the foundation for letting the current, should we say, COVID economy grow to that next level on the 618 retracement. So what does that mean? It means that a V bottom, though, V bottom being defined as going from all-time lows, straight up to all-time highs. I still don't see that as a very high probability scenario. And the reason is number one, debt, right? Debt overall slows your ability to grow, because instead of taking the profits that you reap from, in this case, if you're the federal government, from tax receipts, you have to use those monies to actually pay down your debt instead of, say, an infrastructure bill, which would be more or less demand stimulus in order to grow the economy, right? You just can't happen, or if it does happen, it's going to be at a much smaller rate. So not only does that happen from the federal and the sovereign government standpoint, but it also happens from the standpoint of the consumer. And you can see here, if we kind of look back to 2009, 2009 financial crisis really predicated upon the effects and the risk we had in the mortgage market, represented by the blue line. We're not there yet, but we're close. But if you look at all the different types, the aggregate debts, okay, our auto loans, our student loans, our credit card debt, it's, if you look at where kind of your median was here in 2009, it's higher. So the consumer debt burden is as high and or is as higher as it was in 2009. Well, what does that mean? Well, unfortunately, right, COVID-19 has forced us to do social distancing. It's forced us then to close non-essential businesses. And those non-essential businesses has, forced us to go to unemployment. We're now at a 13% rate of of unemployment right now. Basically, over the past 4 weeks, a total of 20 million people have filed, at least for unemployment benefits. And if they don't have money coming in, they just can't service that debt. If they can't service their debt, that means bankruptcies for them, and it means defaults for the servicers or the people that actually issued them those debts, right? So there's kind of a cascading influence that happens there. And the consumer, if they're paying off debt and they're just buying staples, well, they're not buying anything discretionary, but we're not growing, right? We're staying at a level. And if we're not growing, well, then demand is not going to be, at what it was beforehand. If it's not at what it was beforehand, then it's really unlikely that we're actually going to be at the same all-time highs that we were, a short 2 months ago. And especially since that the opening of the economy is going to be a phased approach, right? More businesses will be classified as basically non-essential, so we'll get people back to work. But some of those businesses will only be at half capacity. So if you're at half capacity, the question is, are you bringing enough revenue to be solvent, number one, and two, you're only bringing back on probably half the workers to basically solve half the demand or address half the demand. So things are going to go slower, and we'll probably have some fits and starts in association with that. I do want to dive into the employment piece just a little bit more. And if we take a look at what that looks like. So if we remember last week, we looked at non-farm payroll, and we looked at non-farm payroll. Non-farm payroll is really pushed out on a monthly basis. But we said that if we got above this 7.5 million mark, right here, then that put us kind of on the slippery slope where you see this overall, kind of exponential growth. And of course, when you see that exponential growth, what happens to the market? It tends to draw back. Well, basically, as we showed in the other slide, the past 4 weeks, we have 20 million, and that's above this 15 million number that we had basically in 2009. So we're off the charts. And the question is, how is that really going to affect us, and what are the opportunities? And that kind of also ties into, we're probably not going to have a V bottom, and this kind of serves as another piece in that argument. But you got to be careful, right? You can't decide that there's just one case out there, right? It's all about probabilities, right? The probability may be low, but what's the probability? What's the case look like? For a V bottom? And if you take a look at that, and we kind of incorporate that into our investment approach, well, then that helps us manage and diversify risk. So let's take a look at that part now, and the contrarian piece of, hey, can we have a V bottom? Why? Well, first of all, let's take a look at what the market has been doing. It's been growing, right? We know that it's above, it's come back at least 50%, right? We saw we're above that 50% bid level. We saw that we have the 618 retracement, so we're still kind of grinding a little bit higher for the reasons that we talked about before. But one of the reasons is that we have this absence of risk, and you can see that our risk indicator, in this case our fear indicator, the VIX, which is really saying, are there people out there buying puts in order to hedge their long investments, right? And the people who do this are institutional buyers for the most part, right? This is your hedge funds, this is your pension funds, this municipal bond folks. This is what they do professionally. And right now you're not seeing that. And the reason why, or I think one of the big reasons why is this right here, is what the Fed did. The Fed did something way different compared to all the quantitative easing they've done before in 2009. And it's just totally unprecedented. Instead of buying just mortgage-backed securities or treasuries, they've actually went to the purchase of high-yield junk bonds. Now, the difference is, and the reason is that they did this because they saw that we were approaching this, basically this spread. Hold on one second. This spread down here, we're up to the red line, that if we started getting to this area, we potentially go from recession to depression. And so they took that step, which overall, is probably a good thing, right? Even though, we saw an opportunity, at least I saw an opportunity to short high yield bonds. They stepped in and bought them. But what that does is it says, hey, we're not going to let folks default. And if we're not going to let folks default, then where is the risk? If there's no risk and there's no reason for me to buy puts, and you can see that there's no reason to buy puts, then the VIX is coming down, right? That's the overall indicator. But the question becomes, what if we don't stop there? What if we go further? What if we adopt an existing model, and that of Japan, and go full-fledged from basically capitalism to basically social or corporate socialism? And what does that mean? Well, Japan is actually, the Bank of Japan owns over 80% and over 40% of the bonds and ETFs on their stock exchange. So the Bank of Japan, i.e. the government, is now the top shareholder in over 23 of the different companies. Basically, they're the top 10 shareholder in over 50% of those entities. Well, if you have the government that's willing to backstop, those defaults and buy those equities, then is there risk? No, there's not. And can we have a V bottom? Yes. So that's something to look at. And therefore, as we look for opportunities, we want to say, okay, the probability is we may not have a V bottom. We want to look at those things from an economic standpoint, identify those areas of opportunity. After we identify those areas of opportunity, make sure then that also provides us a toehold in case this happens. Because, right, anything can happen in the markets. Who knows? I don't have a crystal ball. We're looking at cases and probabilities. So at least this will give us a toehold in the event that, the government does go to this, corporate socialism, which is, who knows, right? Who knows what may happen? They may tell themselves that in order to avoid depression, we need to do this. And if that happens, well, let's take advantage of that. So one of the key thing is that when we want to take advantage of things, we always say the market, we've been talking about the SPX as a proxy for the market, but the SPX is made up of different sectors. And those different sectors, some of them perform better than others. And we just don't want the mediocre, right, performance, as you can see here in these sectors when we're looking at the relative performance of the S&P 500 and from the last kind of half of the bull market from 2014 basically to the present before we encountered Corona. And you can see that we don't want to be in, back then, healthcare, utilities and your financials, they didn't bring you back, that great of return. But if you were here in basically customer discretionary technology and, communication services, you outperform the SPX by a lot. And that's where we want to be. And you can see the absolute performance. Again, these guys on the right-hand side absolutely just crushed it, right? So we want to figure out, based on what's happening in the economy, which of these sectors are going to potentially, right, outperform the S&P 500. So let's take a look at what the new economy looks like. So if we look at a sector-based bullish economy, let's think about what needs to happen in order to open the economy up, because those businesses are the ones that are going to thrive the most, right? So number one, from a testing perspective, right, we need to have a diagnostic test. We need to have higher throughput. We need to have a better test. Right now, the first test is very invasive, and it has to be conducted under certain circumstances with a bunch of different PPE by health professionals. There are some other types of tests where they are much less non-invasive, i.e. saliva tests that are being tested out in Rutgers, which could help this testing throughput. Is that test or someone else, is another university, is another, should we say, biotechnology company going to develop something like that? I'm not sure. But, someone will. At the same time, you need to overall test antibodies, right? We need to understand who has the antibodies, where the herd immunity is, so we can open up different parts of the country from a geographic perspective. If we know there's a good herd immunity present, then that makes as a data-driven decision as far as opening up those areas. Laboratories, right? Once we have the test, they have to process the test, and they need test equipment in order to make that happen. We're going to have to track everything that's going on. There's going to have to be new software applications, right, in the form of passports or something else, coming forward. Again, another potential growth spurt in the economy, something we haven't foreseen before. Treatments. Okay, not only do we have to diagnose that people have the coronavirus, but can we come up with some type of treatment in order to attenuate or alleviate the effects such that they can get their work faster, right? That's going to reduce the impact. That's going to help us overall, open up the economy faster. A vaccine. Okay, we need to prevent this, right, from the prevention side. Now, the prevention side, it's longer, right? It's a 12 to 18 month window, and the reason is because what is a vaccine? A vaccine is an attenuated virus. So you have to be able to culture an attenuated virus in very safe conditions at volume in order to make this happen. So once it's identified, there's a long ramp up to develop and either retrofit the facilities and obtain the substrates and then identify the procedures in order to produce the vaccine at the levels that are required. And then as we move forward down further down the road, 12, 18 months out, our hospitals will not be overwhelmed anymore, hopefully with COVID cases. We'll be going back to our normal everyday lives, and a lot of different procedures that are being classified as elective and put on hold. We are an aging demographic. All those hip and shoulder and knee replacements, we're going to come back in, and your managed care facilities are going to start seeing an overall influx of dollars based upon general traffic. So if you take a look at this, is like, in my mind, it's very difficult to pick a stock and say that these guys are going to make it happen. Who knows? There are so many small biotechs out there that can come up with a vaccine, that can come up that can be bought out. To keep track of all that is difficult. And not only that, you're putting your eggs in very one basket, right? You're a very small sliver of actually participating in that economy. So in my mind, when I look at this, I think from a risk diversification standpoint, this is something that I would do from an ETF perspective. And if you take a look right here, so the first one we're talking about is basically your biotechs. And what's really good about this, these are the guys that are kind of on the back end, that are looking at treatments and vaccines. So you got that area covered. Okay, your healthcare also takes a look at some of your, like J&J and Merck and Pfizer, Abbott, Amgen. They take a look at some of the, I'll say, treatment and vaccine side, but notice you're not overlapped, very much or very heavily based with the biotech. So basically, you expanded your reach and your probability to participate in this market. At the same time, you're seeing some of the, your tests and diagnostic and your infrastructure folks, here as well, like Thermo and those types of folks, right? You're seeing that more here in your medical devices from the infrastructure perspective. That's here. You have some overlap, but it's not too bad. And of course, on the back end, you have your managed care folks, later on down the road. So this gives you a pretty good coverage of, between the healthcare and the biotech, industry sectors without having the need to pick a winner and overall to participate. Now, if folks are stock pickers, yeah, you can, research these. I would start here and I would say, okay, out of the top 10, which are the 4 or 5 you're going to pick. That's another way to, as we say, diversify your risk without being on one. But you also, these stocks are expensive. Okay, I think Vertex, DLD, they're in the $400 or $500 range, and right now you can participate, in IBB in the kind of the $120 to $150 range. And the same thing with all these ETFs, right? You're participating at a much lower cost-effective manner before trying to buy some of these Merck, Pfizer, Abbott, which are that $200-$300 a share, so you're not going to get a lot of coverage. Okay, so that's the first part of the economy. I think that you're going to see grow based upon what we need to do to open it, right? Let's try to definitely consider riding that horse. The next thing is, right, we're working and living differently, and those differences are basically bridged by technology. And what is technology made of? Well, number one, it's infrastructure. You have existing capacity with pipe and servers and gateways, and you need to manage that, and you also need to grow that capacity in order to handle the additional load. Okay, and user devices. A lot of folks had their old we have to rely more on these devices more than ever. So there's an upgrade path, right? There's an expansion path of we want them to do more because we need them to do more based upon the social distancing of what the virus has caused us. We need to collaborate, especially on the corporate side, right? We need to share different documents. We need to have video conferences. We need to have chats. We need to have access to different functions to get the teams to work together in order to achieve a solution to keep businesses going. Well, that's the cloud. And in software, right? There's going to be new folks that are going to be inventing new applications to solve these problems. So if you take a look at that kind of ETF type of a structure and think about how you're going to participate, well, right here, you're doing a great job of participating. And Amazon, you have to realize, is that Amazon itself is actually classified under consumer discretionary because it's basically a consumer delivery product, right? It's delivering everything, it's selling everything under the sun. But it also has a huge, AWS, which is a cloud component. So to participate in that and not participate in consumer discretionary, because in the consumer discretionary ETF, that's all your restaurants and your retail and your sporting events and your gambling and your hotels, right? Your leisure stuff. This is a good way to gain exposure to Amazon without having to be saddled or dragged down by the rest of the sector. In addition, Netflix is here, right? Netflix, everyone is streaming everything going forward. And you have, Google, PayPal, right? Folks are going to have to pay remotely, different types of transactions, going forward. And you have some software plays in order to facilitate the collaboration. If we take a look at this part right here, between network infrastructure and end user devices, you think about it, what is in every single one of these devices? You know what? Some form of a chip. So here this gives us exposure to that kind of sector of the growth and the management of that through the semiconductor chips. Now, not only does this work from a standpoint of what's happening in the coronavirus, but if you think about the next big technological push that's happening, kind of, which may be accelerated, which is 5G, right? Bigger bandwidth, more pipes in order to make that happen. Well, these same folks also provide the chips for 5G. So I think it kind of gives you a 2-in-1, push for that. When you think of the cloud, we talk about, Amazon, Microsoft also, the Azure is their big cloud component, making that happen. But the key thing is you're starting to see a lot of overlay, back with your internet and the FDN, ETF. In addition, if you look at this one, Apple is not here. So in my mind, I would probably really focus more on XLK for two reasons. Number one, I don't have all this repetitive piece. It gives me a broader expanse in order to be exposed to these opportunities. Number two, it includes Microsoft, because Microsoft, right, checks all those boxes we talked about. It checks the box of the cloud, right? It checks software, right? Not only Office, but also Teams, and a little bit on the end user devices for sure. Okay, but more than that, Apple. Apple's also one of those interesting companies in the sense that is actually classified as computer hardware, and computer hardware is not doing very well right now. But Apple, being kind of an end user device, is really kind of a different niche, but this happens to be grouped in that you really should have exposure to. Okay, they're just a behemoth in the space. Everyone, iPhone this, iPhone that. They just came out with a cheaper iPhone. That's one way to look at it. The other thing you can do, of course, is if you don't want to be in ETFs, you can just go cloud. And then, of course, you can just purchase Apple itself as a standalone in order to get exposure here. Okay, what else is happening? People are hoarding. They're hoarding the staples. They're locked in their house. They need food. They need toilet paper. They need paper towels. They need rice. They need spaghetti. All right, these things are happening. Stuff is flying off the shelves left and right. Well, where does that come from, right? That's consumer staples. When we talk about consumer staples, well, that's your Walmarts, that's your Costco's, okay? Not only that, different beverages to drink. And it's not just sodas, right? It's your flavored waters, it's your bottled waters, it's your Gatorades, right? That's Pepsi and Coca-Cola. So these things are moving. You can tell that in fact, we are, and this sector is actually outperforming the S&P 500. Remember, the S&P 500 was at 50%. Look where the consumer staples are. Consumer staples are up above the 618, right? So they've done better. In addition, this is kind of a good defensive one. As this demand kind of decreases and people stop hoarding, well, they're still going to be buying these things, right? So even if the market, number one, if it starts to drop, well, these will spike back up. If we start coming to kind of the new normal, well, you don't have a lot of risk associated with this. So this is a kind of a good defensive piece to be in that has an opportunity for growth, but at the same time, if the market goes the other way, really serves as almost a hedge in some senses. Okay, and then lastly, we have to take a look at something completely different and out of focus, but it's just kind of an interesting confluence of timing in the sense that, number one, because we've cut back on the economy, basically the demand for oil has gone down, especially in China, right? China just came out. They have negative 6.5% growth in their GDP, the first time in the past 15 or 20 years, where it's been almost basically the mirror opposite, growing at 6%, and the U.S. is only growing at 2 to 2.5%. So if the second largest economy in the world is basically contracting, well, they don't need oil. Well, they don't need oil, and so if they don't need oil, then the price of oil is going to go down. Well, unfortunately, the Middle East their whole economy is predicated on oil. And OPEC in the U.S., their interests are not aligned, right? If you remember, Trump was, begging OPEC and threatening them, in August and September to bring down the price of oil because it was too high. And, they basically ignored us, and we just amped up our loans and our bond funding of our shale producers and fracking, and we pulled together a bunch of oil, and we started pulling oil down below that $40 a barrel. Right here you can see the gap. Let's see, where is it? Right, and this is one of the kind of the key benchmarks where people need to be profitable, and what happened is basically the Saudis said, hey, we're going to have a price war. We're going to try to put everyone out of business. We'll put the Russians out of business. We're going to try to put the U.S. out of business because we know the U.S. Shale producers are highly leveraged. So if we can get them to default, well, you know what? There's no more production anymore. And then we own basically the overall source. We become a quasi-monopoly again. We can set the price. And you know what? People are just tired of that. And the way you get tired of that is that you don't depend on them. And the way you don't depend on them is to have a vertically integrated solution, which is alternative energy. So forget about climate change, right? Whether you believe in it or not, think about it this way. This is a pure economic driver. Basically, corporations, municipalities, and utilities no longer can, be, I guess, dependent on an unreliable source that generates a huge part of their income. And so they're going to go ahead and be independent. And if you've seen over the past 5 years, and it's going to accelerate now, that every single major corporation in their bylaws and their vision statement talks about some type of carbon neutrality at some point in time in the future. And they have goals to that, and they're achieving those goals. Well, the low cost of energy, what that does, now it allows them, to increase their profits to actually fund that initiative. Think about that, right? So it's not going to happen this year. It's not going to happen next year. This is definitely a longer play, but this is something that, from a pure economic standpoint, is going to happen more and more. Now, the great thing is that you look at these two ETFs and that, we talk about alternative energy. We're talking solar, hydro, wind, potentially some nuclear, biomass. And this gives us, GEX gives us a great look to all this. And not only the basic technologies, but the technologies that underpin this, like battery storage, power transmission, those types of things. What I really like is pairing it with ICLN for two reasons. Number one, you can see that you get a broader expansion. There's not much overlap between the top 10 holdings in both these ETFs, but you have exposure to Tesla. Now look, Tesla trades at $700 a share, They are becoming the leader. It's a very mercurial, high beta stock. It's tough to hold. It's tough to hold, especially at $700. But here's a great way to participate, in what Tesla is doing without the risk or the volatility by using this type of an ETF. So there you have it. That's kind of another thing that's happening as a byproduct of the overall, should we say, COVID-19 economy. So in summary, if you take a look at this whole thing, where are the opportunities? Right? Healthcare and biotech, regular technology, consumer staples, and alternative energy. Right? You can look at the ETFs as some possibilities. Take a look at this, discuss these, with your financial advisor, figure out what makes sense for you. But I think that regardless of what the market does, or what I should say, what COVID does, I think these will be the outperformers, in the S&P 500. I think they have, for the reasons that we talked about. If you are a stock picker and want to look at some things, in a little more detail, and these stocks are, I should say, very narrow verticals and don't have kind of large ETFs in order to diffuse risk. You can take a look at these as well. Roku again is an unplugged kind of streaming, Netflix #2 type of area. EA and ATVI are the gaming pieces. They're doing very well right now as more and more folks are resorting to basically these interactive games as there's no sports on TV. Telemedicine, that's TDoc, that whole idea of performing triage. Right away in order to make a determination of whether or not you need a test. It happens faster and safely. I think that it's going to be continuing now and potentially in the future. Right, think about it in the future. You now have this triage capability such that when you pull someone in, they know exactly what's going on from a treatment. You narrow down the treatment, examination. You're much more focused until you get a much higher throughput. I think it's an efficiency play that the medical industry will probably take a look at. And lastly, document signings. You probably add Adobe to this as well. You can't go into a bank, see if you're looking at a loan for a mortgage. You're looking to apply for the SPA, care package. Any of those things, all those documents have to be electronically signed. And this is a mechanism to do that. So, another area for the stock pickers to think about. And again, this is not a recommendation to buy or sell. This is education only based upon what we're seeing in the market and opportunities. Please have a discussion with your financial advisor around these areas and figure out what fits your need and portfolio the best. Okay, guys. Hey, thanks a lot. I hope that was helpful. Have a great day. Stay sane, and we'll catch you on the flip side.